I think it's a combination of a couple of things. One, obviously, trade is grabbing the headlines, and the measures that have been put in place so far, I don't think do anything to derail the economic momentum. But equity markets in particular are forward-looking, and so they're worried about how is this potentially going to escalate. I think the other big part of the slowdown that we've seen in the recent weeks is the fact that we've been in a vacuum as it relates to earnings. Our bullish case on markets is really predicated on the strength that we're seeing in earnings growth here in the U.S. and around the world, and we're still 3 weeks away from earnings season really kicking into gear. So I think that that's going to be the catalyst that we're going to see in a couple weeks' time that remind investors that the fundamentals, despite these noisy headlines, are still very strong.
That would push the market higher.
Correct.
John, what do you think?
I agree with Stephen. I think he makes a really good point on earnings. Certainly, if you look at the S&P only up 3.5% year to date, but forecasted earnings have gone from probably 140 or 145 in operating earnings for the S&P as of December 31st to call it 160 this year as of today. So when you see that sort of increase, the market has not kept up with profit expectations.
I'm just curious for either of you guys, with the flattening yield curve, is that something that you guys are looking at in terms of, well, moving out of equities into other instruments? Is that a better way to think about the next 12 months, seeing what's going on with this?
So obviously we're watching the flattening yield curve. It tends to be one of the better indicators for recession. We're not seeing any signs of recession anywhere else in the other places that we're looking. And while the yield curve has been flattening, it's not flat yet. I will say that clients now are starting to see opportunities. Cash is a more attractive place to park some of your capital in the short term, but we're seeing them move more from traditional fixed income into cash rather than selling equities.
John, obviously the earnings growth you point out is the main reason the market has stayed so well supported here in the U.S., but there really has been quite a divergence, as Michelle was just talking about, with global markets, underperformance overseas almost everywhere. Is that something that could exert gravity on the U.S. markets, or are we basically getting the message from the markets that the U.S. is fine here?
I think, Michael, you made the point earlier about markets being forward-looking indicators, and if you look at small caps relative to the Chinese market, for example, it's probably a 2,500 basis point spread between the Shanghai and local currency versus the Russell 2000 up, call it 11 or 12%. So I think very much if you look at small caps, if you look at the dollar, while the trade issues are certainly weighing on people and sentiment, if you look at the way the dollar has responded, the way small caps have responded, you know, the viewpoint of if China exports 4 times what we export to them, the market has already voted and doesn't appear that it'll be too scary. And if you think it even another step, if you look at CEO confidence, small business optimism, leading economic indicators, and then corporate profits on top of that, those are all good forward-looking indicators for increased CapEx.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.